as we move into the new year, we're still in this environment where bonds are trending lower, stocks are trending lower, commodities are trending lower. There's relative strength between them, but from an absolute perspective, they're all in downtrends. Good afternoon, everybody. Willie Delwich here for some Townhall Takeaways. Just want to recap the most important charts, the most important observations from this week, and it's almost Christmas, so Merry Christmas a couple days early. Thinking about Christmas carols and thinking about the most wonderful time of the year. Let's think about the most wonderful charts of the year. Let's not think about it necessarily as wonderful in terms of great, but things that are full of wonder, things that make me, what does this mean as we wrap up this year and think about next year? And the first on that list, the first takeaway, the first thing that I'm really thinking about this year is this disconnect, this historic disconnect between sentiment and positioning. We've talked about it all year, seeing numbers this week from a sentiment perspective. The NAIM exposure index dropping 30 points as investors who last week were gung-ho or have taken a step back. The AAII data back to 50% bears. We've been more bears than bulls on that survey all year pretty much. So we've had that pessimism, but it's not been accompanied with positioning. And that has important implications for how we want to think about the market going forward, what the potential returns are for the equity market. So we talked last week about this possibility of a new secular bear environment, given the exposure to equities that we were seeing at the household level, how in the past, 1968 and in 2000, that led to a lost decade for equity markets. Where it basically moved sideways for an extended period of time. We can think about that same idea from a slightly different perspective, this time not from equity exposure, but from a liquidity exposure. Liquidity has really been a key theme this year, and how much liquidity to households have right now, and what does that mean for stocks going forward? So we can think about non-equity assets as a percentage of total liquid assets. They've expanded this year. From 38% up to 46%, but that's still below the long-term average of about 56%. And even more than that, more than just those random levels, what matters here is the relationship between that household liquidity, that non-equity assets, kind of cash on the sidelines, assets on the sidelines, the relationship there and forward stock market returns. And there's an 83% correlation between household liquid assets, non-equity liquid assets, and forward returns for the S&P 500. So that suggests, given where we are from a really low perspective, our starting point, prospective returns are relatively low at this point because we're still in the 10th percentile, if you will, of liquidity. And it means as we go forward and realize those 10-year returns from 10 years ago, they're likely to come down because we've been moving into a less liquid environment over the past decade, which ultimately led to the least liquidity we've ever seen at the start of this year. So that's one of the key takeaways, is how this disconnect between positioning and sentiment is intact, and that probably weighs on equity returns going forward. The second takeaway is about paths. I've shared this over the weekend, talked about it. How this year the S&P 500 really following that path that it followed off of the 2007 peak. Very similar action and drawdown action of 60 so percent correlation between this year and that pullback off of the 2007 peak. And so the question is, do we continue to follow this path, which is the path is lower as we go into the first half of next year, or is there another path that the S&P that the market could take? And that one is the kind of the path post midterm elections. That gets talked a lot about as you typically see strength in that final quarter of the midterm election year, followed by strength then in Q1 and Q2 of those pre-election years. That's a well-established pattern. Lots of stats about the S&P 500 never being down in the year following a midterm election. The S&P could very well take that path, but so far this year, it hasn't done what it has tended to do in midterm election years. So far, it doesn't look like it wants to do what typically happens after midterm elections. There's still time for kind of to get off of the post 2007 peak path and get onto the presidential election cycle path. But so far, it is not doing that. And that's one of the big questions as we go into next year. Will it stay on the same path or decide to jump to a new path? And then the final kind of chart of wonder that I'm thinking about is this long-term trends between bonds and stocks and commodities. We've seen bonds roll over. We've seen stocks roll over. Just a few months ago, we saw commodities roll over. Typically, what happens next after this period where all three of those asset classes are in downtrends, typically we see the bond trend roll higher. So that would mean lower yields for bonds. We've seen some of that, but it's not conclusive at this point. We've seen 10-year yields drop from about 4.2, 4.3, somewhere around there down to about 3.5%. Now with the Bank of Japan raising its ceiling for its 10-year yield, German yields are moving higher. It looks like 10-year yields in the US are moving higher. That probably means it's not time yet for bonds to turn higher and ultimately clear the way then for stock trends to turn higher and commodity trends to turn higher. And so as we move into the new year, we're still in this environment where bonds are trending lower, stocks are trending lower, commodities are trending lower. There's relative strength between them, but from an absolute perspective, they're all in downtrends. So this still this year, it's been a less is more in terms of exposure type environment. And as we go into next year, it looks like we're still in that kind of environment. So those are the takeaways. Long-term trends from an asset allocation perspective, still down. Stocks have a choice to make. Are they going to continue to follow the path they've been on this year in terms of following that post 2007 peak path, or are they going to follow the path that we typically see in going into pre-election years? And then what do we do from an asset allocation perspective at a time in terms of setting expectations at a time when there's relatively little liquid assets sitting on the sideline waiting to be deployed and households have elevated exposure to stocks. So those are the takeaways. Thanks for listening. Thanks for joining. Have a Merry Christmas. I won't be doing this next week. Won't be doing it the following week, but I will be back at it again, January 12th of 2023. Let's see what 2023 has in store for us as we kind of put a ribbon on this year and start to look forward to better times next year. Thanks for joining. Thanks for listening. I'll talk to you again soon.